Hi, I'm Patu from freefincal, and in this video, let's look at SEBI's new liquid fund rules and what it means for investors. So I wrote up this post today, and you can have the link in the description box. So these are proposals made by the Mutual Fund Advisory Committee constituted by SEBI. It has different players. It's got academics. It's got members from the mutual fund industry and so on. So and these proposals were approved by the SEBI board on the 27th of June. So let's go over some of these rules now. So the liquid fund shall hold 20% in liquid assets such as cash, government securities, treasury bills, and repo on government securities. This is essentially to ensure that in the case of a very severe event, like for example, during the 2008 market crash, the big players quickly wanted to pull out money to meet their liquidity needs, and they created a problem in liquid funds and ultra short term funds. The same thing happened in July 2013 when the interest rates moved up almost 2% overnight because the rupee was weak and the RBI wanted to strengthen the rupee. Therefore, people wanted immediate cash for their the big players wanted immediate cash. They want to pull out money from liquid and ultra short term funds, and therefore they could not manage this. So therefore SEBI has mandated that 20% they will hold liquid assets at all times, so that if there is any extraordinary redemption, they can handle it to some extent, at least much better than what they did in the past. This is a great move because of course it will handle they will be able to handle redemption pressure better, but and also the credit risk of the portfolio will be a little bit lower. The credit risk will be lowered because of this exposure, 20% exposure. Of course, returns will be a little bit lower, not too much, but a little bit lower. About that 20% will get lower. See, the problem in the debt fund space is, if you want safety, you get lower interest. If you want more interest, then you have to go and buy a risky bond. The only reason why the market demands a higher interest from a bond issuer is because the market recognizes that that bond issuer has got problems paying back. Of course, it's a very counterintuitive argument, but that's how risk premium in the debt in the bond market works. So now there is a sectoral limit of 25%, 20% now, and I think this is not just for liquid funds. I think it is for all funds, if I'm not wrong, from what I read in the proposal. So the housing finance bonds shall be restricted to 10% exposure, and per institution it will only be 5% overall in the portfolio. And this is a good rule because it will reduce concentration risk to some extent. Of course, once the credit event happens, whether it is 10% exposure or 15% exposure doesn't matter, because if the bond becomes difficult to trade, then the AUM will fall and the exposure will start moving up, and it will go above this 10% limit. So having a sectoral limit, there is one type of bond or one type of one classification of bonds, limiting it to some amount, to some number, is not enough by SEBI. They should say, if the fund is not able to sell the bond and it breaches that 10% limit or that 15% limit, whatever it is, then they should stop the fund for further subscriptions. They should intimate the subscribers, and they should basically wind it up. They cannot. They have breached the rule, so that's very important. And the fund house should do something, or they should side pocket it immediately when it breaches it, and they should intimate investors and so on. So that must be the kind of norms that will prevent. See, this DHFL crisis could have been handled much better if there was such a rule in September itself. In September or subsequent months itself, it could have been handled in a much better way. There was no need for this kind of problem. I've written about this already. The valuation of debt and money market instruments will be based on mark to market and not based on the amortization. So basically, amortization means, so you must have seen these home loan calculators where the principal of the loan keeps decreasing. The loan amount keeps decreasing. In that loan amount, there's a principal component, there's an interest component, and so on. So from the time you borrowed the money to the time the loan finishes, the loan amount will kind of go down linearly like that, more or less linearly like that. The similar thing will be applied in ulta for bond amortization. So basically, this is when you buy the bond, and this is when the bond gets matured. But and the value is higher because it takes into account all the interest rate payments together and clumped it together to a higher value. And then you join from this point to that point in a nice kind of straight line, and that's the kind of NAV valuation the liquid fund used to have without any market fluctuations. The true fair value of the bond in the market will not be reflected in such kind of a nice amortization in scheme. So so what SEBI did was, I think back in 2010 or so, it said only bonds which had a duration of up to 91 days can be amortized. That is, this kind of a non-market linked scheme can be applied. They reduced it to 60 days, then they reduced it to 30 days. Now they have made it 0, which means that no bond can be amortized. All the bonds will reflect the value of the bond will reflect their current value in the market. This means that the liquid fund NAV will be a little more volatile, which is nothing to worry about. But if there is a credit event, immediately it will reflect in the liquid fund NAV. That is what is more important. Interest rate risk is not much in liquid funds because the bond duration is not so high. But once there is a credit event, immediately the NAV will dip a little bit, depending on the exposure of the fund. So, but you don't need to worry about it as long as you choose the correct liquid fund. For example, Quantum Liquid has been employing mark-to-market valuation right since inception, as far as I know. And you can see that in July 2013, because of the mark-to-market, the fund fell that much. But then it will quickly recover within a few days. It's not a big deal. So don't worry too much about this mark-to-market as long as you choose safe funds like Quantum Liquid. Some people ask me about Parak Liquid Fund. So far, it has been holding a good amount of treasury bills, so there's no problem in terms of credit events in that fund. But there is no explicit wording in the scheme document that they will only hold that kind of a portfolio. There is a room for corporate bonds as well in the Parak Liquid Fund, so these things may change. If they are not getting enough AUM in the liquid fund, they may buy more risky paper, risky bonds, and so the returns will be higher, and then it will attract more AUM. So I don't know about that, but in the case of Quantum Liquid, they have explicitly mentioned in their in the AMC in the website that they will not take on corporate bond risk. So in that sense, it's a fairly safe liquid fund. So that's what I wanted to say. Okay, it also says that liquid funds and the next one is liquid funds and overnight schemes shall not be permitted to invest in short-term deposits, money market and money market instruments having structured obligations and or credit enhancements. So basically, this means what happens is, see, the debt mutual fund space has got some very complex products. So it's this essentially means that this is like there will be so there is a bond issuer, and then there is the debt fund manager who will buy the bond. In between, there will be another party. They will take the responsibility of this agreement between the issuer and the buyer. But they will also because they are taking on the responsibility, the credit worthiness of the bond issuer will be a little higher. That's called the credit enhancement, and they will be responsible for interest payments and so on. But in that kind of a situation, what happens is if the underlying guy defaults, then this will also be in trouble. So they don't want liquid funds and overnight funds to invest in such structured obligations, but other debt funds can invest. So be careful with that. So it will essentially increase the credit safety a little bit, but not too much. A little bit. That's all I would say. This is the next one has received the maximum attention for some reason. So there will be a graded exit load levied on investors in liquid schemes who exit the scheme up to 7 days. See, this does not matter for retail investors. Very few of them are going to exit in 7 days, and I think there will be a graded exit load, meaning I think they will say if you are exiting more than a few lakhs, then there will be an exit load of 1%, 2%, whatever it is. It will only apply to big corporate players, because this exit load will. So what will happen is, if there is an exit load, the the interest that they will get over the few days will be annulled by that exit load. Therefore, there is no reason for them to invest in liquid schemes anymore. They will simply move on to overnight schemes, which is what I think SEBI wants. SEBI wants the big players to move to overnight schemes where the liquid funds can manage the liquidity so much better because of the structure of the scheme, and the liquid funds will be, will be a little more safer. So, which is okay. I think it's a very good move in my opinion. Don't worry too much about that. The moment somebody says exit load, we should not worry too much about it. Liquid mutual funds. This is for all funds. They will be mandated to only invest in listed debentures and listed commercial papers, which is fine. And I think it's just another way to ensure the funds are marked to market. So that's about it. It's a very good step. It's step in the right direction, I would say, but the credit safety of liquid funds has marginally become higher, and the returns has marginally become lower. That is the probably not so marginal. Returns will probably be a little lower because 20% is there. But credit safety is only marginal. So don't worry too much about this. But it's of course a step in the right direction. But I think the most important step is SEBI should say the moment the limit, the limit of 10% exposure for a particular company, or the sectoral limit is of 20% or 15% is breached, and then the investors must be intimated. SEBI should be intimated, and the side pocketing should immediately start. If there is no mandatory side pocketing well before a credit event occurs, I think mutual fund investors are going to be subject to such problems. So SEBI should be a little more stronger in this space, and let's see. I mean, we have the budget also, so there may be some news about tax saving debt mutual funds possible. It's going to be that will bring new set of problems. So let's find out. So that's what I wanted to say in this video. Let's do the Q&As maybe tomorrow or day after. So please pour in your questions for the Q&A. You know the kind of questions I prefer. I'll catch you again in another video. Bye bye.